Hi everyone, this is Laura with OTC Markets. We're just going to give it a minute for some more people to join, and then we'll get started in about 1 minute. All right, good morning, everyone. Thank you so much for joining OTC Markets as we discuss Caravan Pro's CECL solution. I'm Laura Hamilton, Vice President of Corporate Services at OTC Markets in New York City. Today, we're here to discuss the functionality of Caravan's CECL solution and how it can provide a low-cost, high-efficiency solution for community banks. Before we get started, I'd like to address a few housekeeping items. All attendees are on mute and will remain on mute throughout the presentation. All Q&A will be addressed at the end of the presentation. Please enter any questions into the box on the right-hand side of your computer screen. There's also the presentation in the handout section and a poll question that we would like all attendees to answer on the right-hand side. It's right above where the drop-down is for questions. If you can do this throughout the presentation, that would be excellent. All contact information will be at the very end of the presentation as well. Joining me today is Tony Hodson, Senior Vice President of Market Data at OTC Markets. Note that today's presentation is solely for OTCQX Bank members. As you're aware, the OTCQX model is to provide less complex, highly efficient, cost-effective solutions. This is why we purchased Caravan earlier this year. Caravan began as a lower-cost alternative to FNL, which many of you probably use. Caravan's latest offering is a CECL solution designed for community banks to handle the new rules that take effect in 2020 and 2021. I'd now like to introduce Tony to go through the CECL solution.
Thanks, Laura. As Laura mentioned, I'm Senior Vice President of OTC's Market Data Group. I'm also one of the founders of Caravan. And over the last 5 years, I've been the lead engineer behind all of the Caravan products. So I'm particularly excited to talk to you today about the release of our CECL solution. Today, I'll give you a quick overview of the Caravan software. We'll go over a little bit of the regulatory context behind CECL, and we'll spend most of our time reviewing Caravan's CECL solution. A little background on Caravan. At its core, the Caravan team does two things. We do data aggregation and application development. On the data aggregation side, we collect public data from regulators. So this is things like call reports, UBPRs, reports of structural changes, summary of deposits, that sort of information. And then we deconstruct that and reorganize it into a more modern data warehouse structure. This is the technical work we do behind the scenes to normalize, tag, define, and relate data elements so that they can be more effectively called by software applications, which leads to the second piece that we work on, which is application development, where we build easy-to-use software that interacts with the data that's stored in the warehouse. Over the last 5 years, these applications have targeted uses like benchmarking, reporting, and analysis, and most recently, we've developed our CECL module. One of the things that makes our CECL solution so unique is its Q&A workflow approach. CECL has a lot of moving parts to it. So by taking a step-by-step approach, Caravan helps to ensure that banks address the full depth and breadth of requirements without getting stuck in a particular area or sidetracked by some of the issues that are on the periphery. Caravan's approach is rooted in the weighted average remaining maturity, or WARM methodology, which is one of the loss rate methodologies approved by regulators. I think it's worth taking a couple of minutes to dig into this, though, because until recently there's been some confusion about WARM. Smaller banks were sometimes left with an impression that WARM might be tolerated by regulators, but wasn't necessarily preferred. This concern grew out of two factors. The first factor is that the biggest, most complex banks are required to implement CECL earlier than other banks. This meant that the first solutions to come to market were necessarily focused on those more complex institutions. And as a result, their CECL requirements were also necessarily more complex than a WARM methodology could support. So the first messages banks heard about CECL solutions involved more complex methodologies like vintage, discounted cash flow, or PD-LGD modeling that's used by larger institutions. Other options like WARM were not yet being highlighted in the market. The second factor that sort of exacerbated this misunderstanding of WARM is that WARM is actually more complex than it initially appears. The entire approach rests on a bank's ability to estimate remaining maturity in a manner that is consistent with other emerging CECL requirements. So in one FAQ, regulators cautioned banks about this, basically saying that WARM was not a silver bullet loss rate method, and it could be more challenging than some banks thought. And banks heard this as a criticism against WARM rather than as the guidance that it was intended to be. So I included in this slide a few quotes to highlight what regulators have actually been saying since the FASB standard was introduced. And in short, WARM and other loss rate methodologies are reasonable and acceptable approaches. Fortunately, this confusion grew to a level that the Financial Accounting Standards Board, or FASB, actually weighed on it directly in a Q&A they released earlier this year. For those who aren't aware, the process of introducing something like CECL typically works like this. FASB establishes a new set of accounting standards, and then the various sector regulatory bodies, in this case bank regulators, interpret that standard and provide more detailed guidance for implementation and compliance. So what's particularly interesting about this Q&A is that FASB themselves are issuing the clarification to try to minimize any confusion or doubt that may be inadvertently introduced in the subsequent regulatory interpretation. And in their Q&A, FASB addressed the WARM issue by concretely indicating that, yes, WARM is acceptable. And to be crystal clear, they even went so far as to provide numerical examples of some of the different ways WARM can be implemented. In April, regulators also issued joint guidance around a handful of other issues. One topic in particular was around implementation timing. Most banks on this call are likely in the second tier, non-SEC filing PBEs, with a regulatory report effective date of 3/31/21. What this means, though, is that your implementation of CECL should proceed at a pace that will allow you to file your Q1 2021 call report using only the CECL allowance calculation. By that time, your ALLL calculations you do today should be firmly in the past. Q1 2021 sounds like a long runway, but keep in mind that this date is the date that your implementation is supposed to be complete. Prior to this, you're expected to have a 12 to 18-month parallel run period in which you're calculating both a CECL ACL and the current ALLL in parallel. Regulators are pretty clear on this. Don't panic, but get started today. It will take you that amount of time. You will use 12 to 18 months to collect that data, refine your approach, and then successfully exit a parallel run prior to your effective date. The timeline at the bottom of this slide comes directly from the OCC, and I think it highlights the time frame in a way that is more helpful and visual. QARAVAN'S application of WARM involves breaking it down into 6 major steps. I thought it would be helpful to go over these at a high level and then look more closely at each. The first step involves capturing a snapshot of the bank's loan portfolio. For reasons we'll address later, This is one of the most common stumbling blocks for banks. The second step is to segment this data. For most banks, this is actually a bit of a false choice because their limited data sets also limit their segmentation options. I'll talk about this more in a few minutes. The third step is really the heart of WARM. This involves observing the characteristics of each loan in the portfolio and using those to forecast a life of loan view. Understanding the life of loan implications for a portfolio from a CECL perspective involves a heavy application of rules and calculations. This is one of the reasons WARM is not as easy as it looks. The devil is in the details with this step. The fourth step involves collecting historical loss data for the bank and a set of peers. This needs to be done at an aggregated segment level, which can be challenging for some banks. The fifth step is to adjust historical loss rates for future expectations. This is similar to the current practice of applying Q factors, but CECL requires a more forward-oriented approach, including the selection of reversion periods. And finally, in the sixth step, the allowance for credit losses, or ACL, is determined by applying the adjusted loss rates that were established in step 5 with the portfolio projections established in step 3. At this point in the analysis, even the smallest of banks will be juggling literally hundreds of thousands of data points, and the model is generally beyond the scope of what can be done in Excel. In the slides that follow, we'll walk through some specific examples of how Caravan has introduced a sense of order and clarity to each of these steps. Data collection is among the first steps, and unfortunately, it's the first opportunity for banks to get stuck. A lot of banks seem to get bogged down here trying to figure out what to capture, how far back to go, and how often to collect data. Caravan spent nearly a year collecting data, input, and feedback from a wide variety of banks to understand the realities of what data is desirable versus what is actually available. We came across some pretty surprising conclusions that helped inform the way we request and collect loan level data. Through this process, we were able to concretely define a limited set of the exact fields needed. And in our approach, we believe this is the kind of shepherding that most banks will benefit from when approaching CECL. We want to make it easy for banks to identify, collect, and upload only the required data into the Caravan system. One of the interesting things we found through our data working groups was that the average bank was only able to collect 8 to 12 quarters of historical data. This is in pretty stark contrast to the regulatory preference for data that covers a full economic cycle. Regulators know about this limitation and have advised that banks in this situation, which is most banks, will need to supplement their own loss data with peer data. If you remember, I mentioned that segmentation is something of a false choice for most banks right now. This is because peer data is only available in a format that uses call code segmentation. As a result, this segmentation is the only viable way most banks can make the needed apples-to-apples comparisons with peers. For the near term, Caravan makes it easy for banks to segment by call code. And as banks collect a deeper data set that is large enough to transition to custom segmentation, Caravan can support that as well. As Caravan parses uploaded data, the software includes a series of algorithms that note important factors associated with each individual loan. Depending on the unique combination of loan traits, each loan is forecasted for its effective life under CECL. The software then walks you through options for adjusting these forecasts based on user preferences. For example, Caravan can identify prepayment patterns in the data for you, or you can apply your own prepayment assumptions directly. And finally, these forecasts are aggregated by segment and prepared for further analysis. This is one of the most complex parts of any WARM approach, but Caravan makes it relatively easy work by organizing inputs and doing the heavy lift around calculations and analysis. Incorporating historical loss rate data generally involves 2 decision points. First, which peer data will you include? As mentioned before, incorporating peer data is a best practice and will actually be a necessity for most banks. Caravan includes tools that make it easy to use a default regional peer group, which is automatically identified, as well as the ability to incorporate any custom peer group you choose. If you're not familiar with our peer group engine, it's second to none, and we fully integrated it between our analytics platform and this CECL solution. The other decision point around historical loss rates involves selecting a look-back period. Again, we make it easy for you to visualize historical trends and select the period of time for which you'd like to focus. For example, you might want to run best, worst, and most probable scenarios. This is easy to do with a few mouse clicks. In step 5, we need to make adjustments to this historical data. This involves addressing 8 different qualitative factors in a systematic way for each segment. We learned from working with banks that this process is easy to get lost in. Banks often struggle to incorporate data and to quantify impacts in a way that can be universally understood and applied. Caravan tackles both of these challenges, keeps users on track, and helps ensure that results can be summarized and applied at a portfolio level. The last step ultimately applies the math and calculates the ACL. The image here is a screenshot of part of the online report. And the system also produces a 100-page stakeholder report. This stakeholder report is written from the perspective of bank management and thoroughly documents the analysis that was undertaken to produce those ACL numbers. I've included several thumbnails of actual report screenshots here. The intent is to highlight that the report contains a nice mix of charts, tables, and narrative. Ultimately, this report reflects the unique analysis undertaken by your bank, presented in a very readable, easy to digest format. This is the consolidated report you would share when your board, auditor, or regulator asks, "What are you doing about CECL?" And finally, I'll wrap up today with just a few comments about pricing. As Laura mentioned at the beginning, the OTCQX model is to provide less complex, highly efficient, cost-effective solutions, and our approach to CECL is in line with this. Like all of the OTC products, we're transparent about pricing, and you can view this information on our webpage as well. Pricing includes 2 components and is tiered according to bank size. There is a one-time onboarding fee and a recurring annual fee. And OTC is also offering QX clients a discount from these public rates. Okay, with that, thank you for joining, and I'll turn it back over to Laura for Q&A.
Thanks, Tony. Appreciate all that insight. So if anyone wants to ask any questions, the box again is on the right-hand side. In addition, there is the poll question, just a friendly reminder to please answer that. We do have one question here. Tony, if you'd like to take this. Do banks use custom peer groups or regulatory peer groups in their analysis?
Typically, banks will start with the sort of regulatory peer group. So, for example, looking at peers on a national level or a state level. But more often than not, banks will tend to move towards a more custom peer group. And if you think of a state like Texas, for example, that has a lot of banks in it, it tends to make more sense to use a peer group that would be more consistent with maybe where in Texas you're located and perhaps what your portfolio is made up of. You know, ag banks in northern Texas are different than you know, other banks in other parts of the state. So generally we see them migrate towards custom peer groups.
Thank you. Now, what if my bank wants to find out more? What's really the typical onboarding time to get started with Caravan?
Yeah, so typically what we do is after this, if this looks of interest, we would schedule a 60-minute demo where you would see live in real time the way the software actually works. We have some data sets that we upload and walk you through the progression of some of the things that you had seen today in more detail. And then at that point, you'll get some exposure to the data that we are actually going to be requesting. And so if it resonates with you and it seems like it's the direction that you would want to move, we would then send you a list of the data requirements, including the data descriptions, fields, and formats that we would need. And typically, what this results in is sort of a 12-week onboarding period. And so this onboarding period starts where we start to identify data together. We iterate through that data because sometimes we find that the data that's being collected is maybe we're asking for things from your core system that maybe you haven't asked for before. So it's exposing sometimes some data anomalies that you weren't aware of. So we'll iterate through that together to get to a clean data set, and then we'll perform your first full analysis with you, and then move you on your way so that you can more easily do the analyses on a quarterly basis.
Fantastic. I appreciate that. So at this time, this wraps up our Q&A session. Thank you, everybody, for joining OTC Markets today. A recording of today's webinar will be sent out to all participants. It will also be on our website, and there is a version under the handout section, again, on the right-hand side of your screen if you want to download that before we send it out. Please don't hesitate to reach out to either myself or Tony with any additional questions. We really appreciate your time, and thank you again for joining us.
Thank you.